As Stanley Druckenmiller in a recent interview said that he still expects the market to be flat for the next 8 years, I just want to give a little bit more of context there as I'm analyzing stocks because that's what I do. And if you want to check this out, this is the S&P 500. If you want to check more analysis, you can check my stock market research platform. This is what I do, where I think the added value is. And if you just want to read the S&P 500 stock by stock, you can find it here. Now we're already 75 down, still a little bit to go, but we'll finish it pretty soon. And you have also the stock of tomorrow here. Ruby's a dividend aristocrat, and here is all the other things that I do, my portfolio, so feel free to check it out if you want. Now, as I'm looking into these stocks, going through them, when I was looking at the S&P 500, I did 25 now, and I was looking at all these big names from Honeywell and Intel, Starbucks, and the valuations there. And I'll just go through, I don't know, 10 of them just to show you how the S&P 500 is risky from an investing perspective and will likely lead to flat returns in the long term. Let's immediately start with Honeywell. Nothing wrong with the business, but at a P ratio of 24, I'm simply not attracted to such an industrial because if you look at things, you can see here, this was 15 years of flat returns. Then you have this jump like you had in the 1990s. And what's most likely coming next is again 15 years, 10, 15 years of no returns, especially starting from a high valuation. So going forward now, the price and this P ratio, this high P ratio, assumes that all what has happened in the great years with industrial supply constraints and everything will continue for the long term here, like the management now expects, great forecasts and everything. Maybe that will happen, but I don't like the risk side of that. Then we have Amgen, Biopharma is simply not for me. And then we have Intel, which is a covered stock on my research platform. It is publicly covered. So again, if you go to my research platform, just scroll to the curriculum. You have Berkshire that's publicly covered. Intel is publicly covered. I likely update at half-year earnings, so not bothering with that at quarterly earnings, but there is a clear strategy there, and that's why we are following it. Now, something very interesting here, United Parcel Services, the cheaper side of the S&P 500, and if you look at this, it has really benefited from all of us being locked down, ordering from home. That's why we have a low P ratio, but you have always to remember that the P ratio shows what has been going on in the past. The dividend year is relatively high, but when you look at revenues, increased costs leading to lower margins, the change from the previous year looks a little bit negative. And analysts are always exuberant. They estimate a return to growth next year. But if that doesn't happen, if this growth doesn't happen, the P ratio contracts and everything, then again, yes, the P ratio is lower, but except for that, there is no advantage in looking at this company. Most of these companies are fairly priced for the S&P 500 perspective inclusion, and what you pay is what you get. On a micro level, I think the S&P 500 is very risky for low return. Like Druckenmiller said, 8 years of no returns, so that is what most likely will happen. Anything can happen. The S&P 500 can double next year, but that's again not my kind of business. ConocoPhillips, oil is cyclical. Just look at this. And then look at where do you want to buy a cyclical? At the bottom of the cycle? Or you prefer buying at the top of the cycle, where you will get better returns? I think that explains everything you need to know with oil stocks now. And The losses here tell me that Conoco has either shorter term oil fields or higher costs, but therefore the high volatility in the stock price and also the volatility in net income. Starbucks, great business, did great for investors over the last 30 years, but over the last 5 years it has been a little bit more volatile as the market doesn't know exactly what the direction will be. But with a P ratio of 34, you are expecting that this great growth that has happened over the last year will just continue forever. But if I look at the numbers, is it really that easy that Starbucks will just 2x in the next 7 years, which would be something to expect for a P ratio of 34? Because if they 2x, then even if the stock price goes nowhere, then the P/E ratio in 7 years is 15. And if yes, they grow, they double 10% a year for 7 years, and then they start slowing down, then this might be a correct P/E ratio in 7 years, and you haven't made any money because of the valuation contraction. So again, that makes it risky. Nothing wrong with the business, nothing wrong with you paying $6 for a frappuccino that kills you faster, but the P ratio is simply too high for me. Same situation here. Everybody loves railroads after this great performance. Warren Buffett bought here by 2015. He got back his price in dividends. Now, at this dividend yield, the macro outlook, long-term outlook and everything, it will take you 50 years to get your price back in dividends. Warren Buffett got it back in 7. I rest my case for railroad-related questions. Lows, okay, P ratio standard, dividend yield standard, of course, they had pandemic benefit, but if they come back to normality, 2019, that's a P ratio of 50, which then again makes it risky in a competitive environment. AT&T dividend isn't holding the stock up. Okay, there was the Warner Bros. Spin, etc. But the key factor here is debt. So if you have 123 billion on debt with interest rates going higher, they now still have low interest rates, so the cash flow is there, but this cash flow can get 50% down as interest rates go up, which then means another dividend cut, which then means more risk. So again, not interested into it. Growth stock, P ratio of 63, not for value investing. There is always the question, how much more growth is there? PayPal was a growth stock, as we discussed in a video recently, and you all see what happened. So artificial intelligence, somebody else might come in, might not, but that's not something for me. Credit rating agencies that brought to the financial crisis at a P ratio of 42, mergers, acquisitions, yeah. But if there is a recession, it would lower revenues, profits, and the valuation. That's a trifecta of bad things, and you are back to here. What's that? Oh, that's 75% down potential. Again, a risk I don't want to take. Medtronic, stagnating business, but still average market P ratio, average above average market dividend. So again, okay, but nothing special there. Qualcomm, the semis cycle. When things boom, everyone is excited. When things are in a limbo, everyone is, okay, can it jump back? Can it not? When things are in the doldrums, nobody wants it. And that's exactly where you want to buy it. Now, there are three ways to buy semiconductor companies, and one is just buy it and catch the trend, which is very hard from a timing perspective. The other one is to buy it at book value, like we discussed with Micron in a video. But with Qualcomm, they have no book value because they did a lot of buybacks. This is the downward trend in the cycle. You can calculate net average income over the last years, and if you do it, you end up at 5 billion, which then gives you a P ratio of 25, which doesn't make it a bargain. Yes, if you look at the latest earnings 2022, you see a P ratio of 10, but if you adjust, then it's 25. Of course, anything can happen. Semis can rebound this month, next year, 2025. That's what everyone is waiting for, but we will see. Prologis, this is the first REIT on the list, thus the most expensive. They have been growing by issuing debt, issuing equity, buying properties. So buying properties at peak prices and lowest interest rates. Everything looks great, now a little bit less, but still the risk is too much here because of the business model. Yes, logistics are cool now, everybody wants them, but as everyone wants them, so are they paying higher prices for low dividend yields, and this tells you everything you need to know. Now, with Boeing, again, the market cap is 124 billion. And if you look at the free cash flows, the top they reached was 13.6 billion in 2018. Then they have whatever has happened, unfortunate things over the last years, but they are climbing back. So even if they reach this and then keep it without ups and downs, without issues that happen here and there, then you would get to a P ratio of 10, which then would lead to likely going to market average P ratios, thus 20. Thus, you can see the stock here from 200 reaching likely 400, like it was the case here. That is the reward. On the risk side, a weaker year, issues, recessions, cancellations, who knows what, volcanoes might keep it where it is now. And that is the risk and reward. This is more about, oh, I own Boeing, it's a great business, great American business. So if it feels well, okay, but you won't get rich on this, or it's very, very unlikely. IBM managed to completely destroy its business from 16 billion of net income when Buffett bought and then thought mistake and sold, went to no net income at all, huge competition in an old business culture that doesn't lead to much. And the dividend is likely still holding the stock. It will rebound. There is value in segments, in spin-offs, Kindrill, Red Hat, whatever, but it doesn't show the competitive advantages it once had. So again, big market cap, so index funds have to buy it, dividends funds are buying it, but the story is pretty clear. GE, another example of how the management destroyed the business. I wrote about this somewhere in 2015-16, how Immelt, I think, he forced buybacks no matter what the business was doing, just to get his golden parachute, the stock options, retire with 150 million or something like that. And he destroyed approximately 100 billion of market capitalization to get 100 million of retirement. That's corporate America, so be very careful with whom you put as the CEO. Now again, the culture is there, it's very difficult to clean it. There might be a rebound, it might go up another, 50%, 100%, but once the culture is there, it's not going to be a long-term compounder ahead. You can make some money, you can hold it in your portfolio, but Warren Buffett also sold this one, so that tells you a lot. Caterpillar, people forget maybe that this is a cyclical, and if a recession arrives, commodities go down, investments go down, and everything will suddenly look bad for Caterpillar. And if you look at the chart, 2009, 2015, 2020, and here is the recession that didn't happen, and then it boomed, and now again slowly down. As an investor, if you think, when it's better to buy Caterpillar, when earnings and everything, the company looks powerful, does buybacks, or when the company looks terrible and nobody wants to touch it. I'll let you find the answer to that one. Goldman Sachs, Morgan Stanley, as said, I don't do financials, not my kind of business. Insurers also not. It's very difficult to know what these have on the books. Maybe an actuarial calculation makes them very profitable, but the reality is completely different. I'm not going to spend my life analyzing that, so that's not something for me. This is a growth stock. If they manage it, great. If not, okay. And when it comes to growth stocks, okay, this is what, 10x from here. And now think, oh, 10x, I missed that. And many think, oh, I was going to go more and I'm going to miss that run up. I'm very happy that I missed this 10x because of the risk and reward. That's a different style of investing. We make 10x in a different way. I made 5x here. Then from 2018, when we started again, we made 2x here, and that's 10x. So I made also 10x, but not by owning a growth stock. So just a different style of investing focused on risk. Nonetheless, food, great business. Look at the stability compounding there. But now again, booming, high PE ratio, low dividend yield. So don't expect miracles. It's most likely that there will be issues rather than miracles. Financials, insurance, and war stocks is what I don't do. I hope, and you should as a shareholder, hope that you lose money on this one. So we'll see what happens there. And booking looks great with more traveling coming. It should boom. P ratio is 26, not that bad for a growth company, but the last 3 times I checked things on Booking, then I went to book directly because it was much cheaper. So the business model, when people understand that, might be in jeopardy. What's the mode? Yes, you go there, but people, customer preferences, speed and everything, it's quicker or it can quickly change. Therefore, at these prices, yes, it did greatly here. But you must also keep in mind this. So there is always the risk and reward. People always forget about the risk when it comes to investing. Only look at the reward. Focus first on the risk. And now it doesn't look as great as it did in the past. If you just go to my research platform here for reference, you can also check the first 50 if you just want to read it. You can check my research platform if you want to see what I own, how I'm structuring my portfolio, the research there, interesting ideas maybe at this point in time, and get value by saving time, letting me do and check and all the research as I did here. If I save you 100 hours in a year, I'm sure it's worth the $500 that it costs. Thanks for watching, and I'll see you in the next video.